welcome to our weekly webinar. I thank all of you for taking the time out, as always, to attend these particular webinars. I greatly appreciate your times, folks. In today's webinar, obviously, the main topic that we are going to discuss is going to be how to trade indices. Now, this has been a very, very famous topic among our traders, and there is a huge demand. People keep asking me to keep repeating this one every time. I think mainly because we do talk about various different markets at the same time, and then those markets are very much the equity markets that we're really referring to. Now, a little bit about myself. I come with a wealth of institutional trading. I have worked as a hedge fund trader with Bank of New York Mellon, Bank of America. I am heading the research department at AvaTrade for a fairly long time, and we produce daily analysis on our website and various different videos on our YouTube channel. All of that I will show to you guys in a bit. But as always, I want to begin the webinar by asking you guys with a series of 3 questions. First of all, please say yes if you have attended any of my previous webinars. There you go. A few yeses are already coming in. Great. Okay, a lot of people. Well, this is so good to see so many old people consistently attending them, and then really, increasing their knowledge skills. And of course, I'm so thrilled about all the new people who have joined us this week as well. And hopefully, this webinar will be very helpful to you guys. Now, the ones who have already joined us before or they have attended any of my webinars, please bear with me while I just go through the normal routine of a few things. So the second question which I want to ask you guys is, please say yes if you have been trading under a year. So only those people who have been trading under a year, okay? So fairly, again, a very, very large crowd, so who've been trading under a year. Okay, so we can say that most of the people over here, they are new to this market, and obviously they are very eager to learn more about the market, and that is exactly what we are going to do. So now please say yes if you have been trading for over 2 years. Okay, very few yes, but still there are some yes coming in. So okay, that is good, because now it means that we have a mixture of 2 different crowds, and it really it is a really good thing. So let's begin by looking at the slides first of all. Now I will try to answer your questions as we go along, but at the end of the session we will give you a better opportunity to ask more questions. Now, as always, the most important thing before we begin is going through this warnings and disclaimers. So anything that will be discussed in this particular webinar cannot be perceived as an advice. If you are seeking for one, please do consider consulting with your own financial advisors. Now, of course, the full disclaimer is right in front of you. Feel free to take a screenshot and to read more on AvaTrade's website. Now, folks, the most important thing for you guys is to know the information and the contact details. If you need to contact us, which I am sure that you guys do, because I love chatting and getting really involved in conversations. And if you guys have any questions in relation to your trading, in relation to markets, please always feel free to contact us on Twitter. My Twitter handle is right here. I will show it to you in a shortly as well, and of course on AvaTrade as well. Now, as always, I cannot stress enough about this particular factor, that how important it is for you guys to be on Twitter. Why? Folks, anything which breaks out with respect to market, the breaking news, nowadays it comes on Twitter more rapidly than anywhere else, because normal publications take a lot of time in order to compile that information, and before you know it, there is already a significant move in terms of your market. So this is why it is very important for you guys to join the Twitter trend, and then start following the people that you like the most, start getting involved in, because then you will know if the euro dollar or if the gold price has spiked or whether it has dropped. Why is that? Because whether it is down to the Donald Trump's rate, or whether there has been some breaking economic data which wasn't on your trading diary, or you weren't already aware of that. This is where really I think the key strength of this one is. Now, in addition to this, on a daily basis, I produce 2 different videos, folks. Firstly, it is the fundamental video, which is a very generic sort of information at a very basic level for you guys to understand what exactly is going to drive the market on that particular day, and more importantly, what derivatives are likely to be moved because of those major fundamentals. So that is what I do in my fundamental videos. Again, I will show you the links of that. And secondly, this is the technical. So I really take the technical analysis from the basic level and then take it to the advanced level, going deeper into the price action. So for those of you guys who really believe technical analysis, the importance of a technical analysis, I think these 2 can be really great sources for you guys. Now, where to find all of this information, let me show you guys. First of all, this is AvaTrade's Twitter account. Please make sure when you follow the right account with the verified account sign on next to that. So again, you can see there are tweets on this, so you can get involved in the conversation. This is my Twitter account, my personal Twitter account. Again, you can see, folks, that I am very, very active. I'm producing small videos for you guys every single day, which is less than 2 minutes as well, and then it really gives you all the details with relation to that. Now, the next one is your AvaTrade's YouTube channel, or just say AvaTrade's TV. Over here, these are the videos, the daily analysis videos that we have talked about. Here you get all the irrelevant information that we have just referenced to earlier. Now, let's continue further and get into the main part of the webinar. Now, the agenda for today is why to trade indices, the inverse of indices, the fund flow, defining levels, and defining strategy, right? So that is what we are really going to cover in this particular webinar. Now, why to trade indices? That is the most important question. Now, the reason that we trade indices is because, as a retail investor, I do not have too much of a capital to deploy across 10 different stocks. Now, given the fact that everything is rallying with respect to the NASDAQ index, I want to buy Microsoft, I want to buy Apple, I want to buy Netflix, I want to buy Tesla. That requires quite a large capital for me to put my eggs in all of these baskets, right? And then even then, my diversification isn't really that great, because I'm still exposed to a number of different stocks, but the exposure isn't really as wide as the NASDAQ 100 index. So if I buy the NASDAQ 100 index, I have exposure throughout the full index, the full 100 stock index. So, a particular move in one stock doesn't really going to bother me too much. Otherwise, I need to build my position in Amazon, in Microsoft, in Tesla, in Netflix, and in so on and so forth. Like, there's so many different nice stocks that you perhaps want to have an exposure. But buying the NASDAQ index, or the S&P 500 index, or the Dow Jones index, it really gives you a huge exposure to all the stocks that you perhaps like, and more to that as well. And more importantly, the volatility is even more intriguing, because these indices, they move a bit more than the normal stock price. Of course, in certain cases, it is true that if you are good in picking up stocks, then you are likely to make more gains by picking up some specific stocks. But at the same time, you are also exposed to a major, bigger risk as well, because if Microsoft starts to drop and then you have a huge position in Microsoft, you are likely to suffer from that. Now, what is the inverse of indices? Now, obviously, this is a master class. I'm not going to go into much detail into it because given what our audience are and the background, but I will go a little bit more into inverse of indices. So, for example, if the S&P 500 index starts to move higher, currently we can go long and we can go short by using the CFD positions, right? But then there are also inverse of these indices as well, meaning when the S&P 500 index goes up, you have another indices which are actually moving in opposite direction, and of course vice versa as well. So sometimes investors like to take positions in inverse markets as well, and then they do exist, for the S&P 500 index, for the Dow Jones index, for the Russell, for the Nasdaq as well. So so that is a very, very sophisticated way of trading, which is not part of this curriculum, at least given what the audience strength is right now. The other important aspect with respect to trading indices is the fund flow. So meaning, for the S&P 500 index, the ETF, the exchange traded fund, which really tracks the S&P 500 index, is called the SPY, SPDR, right? Now, obviously, what we do on a daily basis is that I look at the fund flow. I see whether the funds are going in, whether institutions are buying into the current rally, or whether institutions are sitting on the sidelines and they are not interested whatsoever in the current rally. So that sort of information, along with the CFTC data, again, that is a very complex subject. I don't want to go into too much of it, but just to on the overall surface, CFTC data provides us information with respect to leverage in a speculator's position, meaning where the hedge funds are taking positions. So that data and the fund flow combined together gives us a good indication whether whether the current momentum is likely to continue and who is really behind the current rally. Now, folks, questions so far before we go into any further from here? Are you guys clear what we have discussed so far? Any confusions? Remember, there is nothing as wrong question or silly question, so always feel free to ask them. So some of the questions are coming that how could we track hedge funds position? So the CFTC data, if you type CFTC in Google, you will see the resources for that, and then under that you will see some of that. But if you are eager to learn more, then stay with us, and then maybe we can start making some videos, YouTube videos on that, if there is a sufficient interest there, and then I can really help you with that. So another question is coming up that sometime indices is more of a comment than a question that jump 100+ point. It is very, very common for indices to make such a move, especially for the Dow Jones index. Now, the volatility not too long ago, only like 2 weeks and 2 ago, remember the Dow Jones index plunged over 1,500, in fact 1,800 points. That was an enormous move, and that's fairly very, very recent move. I will talk about that in a short bit. But 100 points for an index like Dow Jones, the futures are down on a daily basis for that much, so it doesn't really bother that much for those indices. But yes, from day traders perspective, that is a great opportunity, because the bigger the range, the better you can position yourself with respect to the highs of the days and the lows of the day. And if the index ever reaches or to those lows and then it retraces back or from those levels, that could be really an opportunity for that. And that is why I think it remains a quite good opportunity from that perspective, right? Right, so now before I take any other further questions, so let's continue and let's move forward with this approach, and then let's see what exactly now the indices are doing. Now, as always, folks, what we are going to do over here is really we are going to look at the prices. The information is really going to be the same on all different time frames for all different derivatives. When I say information, I mean in terms of indicators that I'm going to use. So the indicators that I love the most of them are as follows. First of all, I always begin by looking at the weekly time frame, and I draw my 50-week moving average, not the day, and then I have my 100-week moving average followed by my 200-week moving averages. Why? Because this is where we see most of the hedge funds, bigger institutions, pension funds looking to buy or sell their positions. So the moment that the price retraces to any of these important levels, as it did over here, and this is the day when we saw that 1500 move in the market that we really talked about. Sorry, it was actually right over here. And then this is really when it happens, so 3 weeks ago when we had that. Now, obviously, every single candle over here represents a full week. Now, when we see it, the price action with respect to the moving averages, what we see is for the Dow Jones index that it is trading below its 50, which is a weaker sign. It is trading below its 100. Again, another weak sign, but hopes are alive because the index is trading above the 200-week moving average. Now, similarly, let me actually ask you this question, these guys. Are you guys a long or short on the Dow Jones? Okay, some people are saying day to day. That is very good. More people are saying they are short on that. And some are saying we don't have positions. All of them are really good answers with respect to your own risk parameters, and some are saying they are even long as well. I mean, there is an argument, like I said, there's an argument on the long side, and the argument for the long side is because the index is trading above its 200-week moving average, and as long as it remains above that moving average, the momentum is likely to continue to the upside. But if it falls below that, then we are clearly, in a downtrend, and then clearly, the price is going to visit this one. I love to see the price coming back into this level, but the recent reaction, the price challenging its 100-week moving average on a consistent basis. We had a close above these moving averages that was very positive. The next week, the price made a further confusion because we had a higher high but a lower low as compared to the previous candle. And then from the week after, we made another lower low, and now this week is a very small trading range, so the price really doesn't know which way it wants to go. So this, and then we are very much within the range of our last week. So extremely boring price action for this week. I know you guys are putting a lot of questions there, but I just wanted to get through this material as quickly as possible as well, because we are running short of time as well. Now, when we switch to a smaller time frame, your daily time frame, what we're really looking at is again the same moving averages, but the change from weekly to daily moving averages. Now, for those of you who are long, again, you have a very much support from the 50-day moving average because the price is still trading above it. But if the price starts to fall below the 50-day moving average, then you may want to reconsider your positions. And if you are short on the Dow Jones, the positive sign is that the price hasn't been able to move above is 200-day moving average, and that is again, a sign that the bulls have lost their momentum, or it's not at the same magnitude that how it used to be. And again, another bullish sign that we have is that the 50-day moving average has crossed above the 100-day moving average. But again, for that to remain in place, the price needs to remain above the 50-day moving average, because if that doesn't happen, then clearly we know that we have a wrong signal for this particular price action. Now, quickly, we are going to pick up a little bit pace. We're going to go into the S&P 500 index. Again, all the moving averages remain the same. We're going to get rid of all these unnecessary indicators, such as the Bollinger Bands and everything else over here. Just going to leave the price and the price itself. Again, for the S&P 500 index, what we see a lot more strength over here as compared to the Dow Jones index, because on the weekly time frame we are well above all the moving averages, and we are well above the previous week's high as well, and we are very much challenging the last week's high. So that all is positive. Again, a question for you guys: are you long on S&P 500 index, or are you guys short on S&P 500 index? Long. Okay, a lot of people are long. Okay, I mean, again, there is a strong case to remain long, as I discussed with you, and this is all about, this is all about clearing the noise from the actual data, and then the data tells us that, look, the price action is still very much bullish. The price action is still looking to continue its journey to the upside. But for me, the concern is that the price hasn't been able to hold its level towards its peak of last week, and now it is retracing. But obviously the retracement isn't that great. If the shorts are going to work, then the price really needs to move below its 50-week moving average. And the moment that we change the time frame and we go into a daily time frame, another bullish signal is about to come as well. First bullish signal was when 50 moved above the 100, and then another bullish signal which is coming is that the 50 is about to cross above the 200-day moving average. Again, that is going to be a golden crossover, and that is going to be a very positive for the price action as well. But keep in mind that as this 50 picks up its momentum and it gets more closer and closer to the price action, and the price action doesn't take its momentum to the upside, then the chances will be that the price will drop below its 50-day moving average. And the moment that it drops below the 50 and remains below the 50-day moving average, the conversation will be back on board for the prices to revisit the COVID-19. Once again, I like to see the prices to come back and give us another opportunity at these levels. We have been waiting for a long time now, ever since March, but we haven't had that opportunity, and it seems like that the opportunity may be coming now, because now the price action has started to consolidate quite a lot from here. Does that make sense to you guys? All right, okay. Now we will quickly move into S&P FTSE 100 index as well. Look at the price action from here as well, from this perspective, see where we are moving. Again, the moving averages are going to be very much the same. We are not going to move the moving averages from their current levels. But what we are going to do is we are going to get rid of unnecessary indicators such as MACD and all of that. I just don't like to have them on the chart when I do my analysis, when I look at, because I really wanted to pay more attention to the price action and the price action only. I don't want it to pay, get boggled by looking at the indicators, which are lagging indicators anyway, because the price is the first and the most important indicator when it comes to it. Now, when we look at the FTSE 100 index, what a move that we have seen during the past few weeks. Obviously, this was very much struggling, and it is still very off from its all-time, this year's high. Still long way to go, and it is still trading well below all the important moving averages. So by looking at it, you can clearly see that the FTSE 100 index is the most weakest index among the two other indices that we have talked about. Of course, the reason that I didn't take the Nasdaq too much, because that is in its own entirety, it is just continuously making higher highs, and there is no discount there. So if there's no discount there, I really don't see an opportunity. But in my own personal and humble opinion, I wanted to see the opportunity where there's a clear track of a price, what the price has done before, and it is easier for me to really form levels from there and then talk from that perspective, and then make positions accordingly. Now, again, on the FTSE 100 weekly chart, what we see is that a massive bearish candle is about to be formed, as you can see from here. The price action last week already formed a lower low as compared to the last week. So this pretty much confirms us that the FTSE 100 index is likely to face more pain, especially if the price breaks below this week's low. And clearly the trend is already to the downside. We have nothing which is supporting us for the bull case on the weekly time frame. But the moment that we change the time frame and we go on to a daily time frame, the situation does begin to change, because first of all, the bullish signal came when the price moved above the 50-day moving average, and the second challenge right now that the price is having is its battle with 100-day moving average. Now, considering that today's price is trading below the 100-day moving average, and if we get another close which is below this 100-day moving average, then we are really looking at this 50-day moving average again. And given the fact that the price already pierced this 50-day moving average at here, but it closed above that towards the end of the day, I think it is likely for the prices to break below that. So again, be very careful with respect to the FTSE 100 index, because I think the price action is very much bearish with respect to it. So someone is asking, would you expect these indices to move in the same direction but in the different magnitude? Yes, for sure. This is what we have seen so far. Can you please check vk.fr in European tickets? We will check DAX. We won't have a time to check VKFR, and I don't know what you mean by VKFR honestly as well. But I will just quickly bring the DAX before we call it a day, or give you guys an opportunity to ask a little bit more question. Again, the DAX index, the performance has been absolutely phenomenal with the help of the ECB. That the momentum which started from here, since the second week, this has been just, the market has been on a tear. You can see from here that it's on the 10th of May, the price just been in a very, very different range. Now we are seeing still the bullish momentum, because the price is trading above all the important moving averages. This week we have already formed a higher high as compared to the last week, but again, last week we have formed a lower low as compared to the previous week, and this remains a concern. So let's see where we close towards the end of this week, because if we start to close below these two important moving averages, your 50 and 200, then the game can really change for the DAX index as well. Otherwise, the price action still looks very bullish, even on the daily time frame as well, because the price is above the 200 and of course the 50 and 100. The crossover is also about to take place, meaning the momentum can really continue to the upside. This is much better index as compared to the FTSE 100 in terms of its momentum, but we want to keep the price, we want to see the price to remain above its 200-day moving average. All right, now folks, this is your opportunity to ask me one or two quick questions before we really call it a day. All right, so the questions are coming in. What about the dollar index? Again, with respect to the euro dollar or anything which is slightly off topic, but dollar is again a very small measure over here, and we probably want to avoid that for the time being. when you say price action, what exactly you look at? Candle formation only? What else do you look at regarding price action to determine? When I say price action, I'm really looking at the candles, because you know the price action within the candle, how the candle has performed with respect to the previous candle. Are we having a higher high? Are we having a higher low? And we always compare them with respect to either moving averages, with and that is the most important thing for me to really look at. All right, folks, I think this is where we're going to call it a day. Thank you so much for your participation, and I really appreciate you guys taking the time out as always, and we'll see you guys next week. Again, the recording of this one will be available on our YouTube channel.